An introduction to the stock market refers to a basic overview of what the stock market is, how it operates, and why people invest in it. Investing in the stock market can provide individuals with the opportunity to grow their wealth over time through the potential appreciation of their stock holdings and the receipt of dividends, if the company pays them. However, investing in the stock market also involves risk, as stock prices can be influenced by a variety of factors, such as macroeconomic conditions, company performance, and investor sentiment. So now we can discuss about the stock market and its strategy. What is stock market? The stock market refers to the organized marketplace where publicly traded company stocks are bought and sold. The stock market is seen as a barometer of the health of the economy, as it reflects the confidence of investors in the ability of companies to generate profits and grow. By buying stocks, individuals and institutions can own a piece of the company and benefit from its future financial performance. The stock market includes exchanges such as the New York Stock Exchange, NYSE, and the Nasdaq. Importance of having a strategy for investing in the stock market. Having a strategy for investing in the stock market is important because it helps investors make informed and intentional decisions about where and when to put their money. A well-thought-out strategy can help an investor achieve their financial goals, minimize risk, and maximize returns. A strategy can provide a framework for decision-making, ensure consistency in approach, and prevent impulsive or emotionally driven investments. Additionally, a strategy helps investors keep track of their investments and adjust their portfolio as needed, based on market conditions and their personal financial situation. In short, a stock market investment strategy can help ensure that an investor's hard-earned money is working for them in the most effective and efficient way possible. Types of stock we are having. There are two main types of stocks: common stock and preferred stock. First one is common stock. Common stock is the most common type of stock and represents ownership in a company. Common stockholders have a right to vote on certain company decisions and are entitled to receive dividends if the company pays them. They also have the potential to benefit from the company's future growth, as the value of their shares can increase over time. Second one is preferred stock. Preferred stock represents a type of hybrid between bonds and common stocks. Preferred stockholders have a priority claim on the company's assets and earnings, and they typically receive fixed dividends. Preferred stockholders do not have voting rights, but they have a higher claim on the company's assets than common stockholders in the event of bankruptcy. Market trends and cycles. Market trends and cycles refer to the historical patterns and movements of stock prices over time. Trends. A market trend is a general direction in which the market or a security is moving. There can be short-term trends, lasting from a few days to a few months, or long-term trends, lasting several years. Market trends can be upward, bullish, downward, bearish, or sideways market. Cycles. A market cycle refers to the recurring patterns of economic growth and contraction. There are different types of market cycles, such as business cycles and economic cycles, that can impact stock market performance. Market cycles can last for several years and are characterized by periods of expansion, peak, contraction, and trough. Understanding market trends and cycles can help investors make informed investment decisions and potentially benefit from market conditions. However, it is important to remember that past performance is not a guarantee of future results, and that market trends and cycles can be influenced by a variety of factors such as macroeconomic events, political developments, and natural disasters. Economic indicators. Economic indicators are data points that provide information about a country's overall economic health and can impact the stock market. Some common economic indicators include: First one, gross domestic product, GDP. GDP measures the total value of goods and services produced within a country's borders. A growing GDP typically signals a healthy economy and can be seen as positive for the stock market. Second one is employment of employment. The unemployment rate and non-farm payroll data measure the health of the labor market. Low unemployment and strong payroll growth can be seen as positive indicators for the economy and the stock market. Third one is inflation. Inflation measures the rate at which prices for goods and services are rising. High inflation can erode purchasing power and reduce consumer spending, which can be negative for the stock market. Fourth one is interest rates. Interest rates set by central banks can impact borrowing costs and consumer spending, which can influence the stock market. The last one is consumer confidence. Consumer confidence measures how consumers feel about the economy and their personal financial situation. High consumer confidence can drive consumer spending and boost the stock market, while low consumer confidence can have the opposite effect. Economic indicators can provide valuable insights into the health of the economy and can impact stock market performance. Investors often pay close attention to key economic indicators and incorporate them into their investment strategies. So this is part 1 of the stock market. If you're interested in this topic, then you're in the right place. We provide facts and strategies. Don't miss out on new videos and updates. Hit the subscribe button now and activate the bell icon to get my notifications when we upload. Like and share with your friends who are interested in this topic. See you in the next part.